We talk a lot here about kind of the hope, the promise of technology, the promise of AI. But on this same day, we're also talking about, I guess, some cracks, if you will, in sort of the industrial side of this economy. Piece it all together for us. What does it all mean?
Well, yes, and actually yesterday when I saw the jobless claims jump above 240, that concerned me. Now, it is a volatile series, but we are seeing softness. The technology is just sucking up all the oxygen in the room. And I think there's a little bit of FOMO going on among money managers. I mean, if they don't own, Apple, NVIDIA, or Microsoft, they're going to be falling behind. So, as we get to the end of June, that's 6 months portfolios. They've got to show that they've owned some of these stocks that have gone up so much.
Yeah.
So you really see a narrowing market, as you guys have described it. That's not usually a real great sign for future gains.
But when you talk, it's interesting, too, you talk about some of these money managers that, of course, have to show that they're part of the party as well. And a lot of them are still on the sidelines here. Is it too late for that? I mean, I know we sort of get into these sort of quarter-end rebalancings or window dressing, if you will. Is there even time for that, though, at this stage?
Well, the trend can continue so much longer, and it almost always continues until these stocks get overvalued and are forced to correct. But right now, I mean, listen, these stocks are delivering the bacon. They're delivering the earnings. Yeah, they're selling, I guess NVIDIA is 50 times forward. The others are more towards 35 or 40 times forward. But we all know, you talked about this as the biggest outperformance in 20 years, but it was 20 years ago when these stocks were selling at 100, 150, and even 200 times earnings, Cisco and a few of the others. So can it become even more overvalued? Oh, yeah, you bet it can.
Overall, Jeremy, we're really seeing, 27 all-time highs on the S&P this year. I mean, it gets a little ridiculous after a while. Is this just
again, it's been 20 years since I've seen, as you say, an outperformance this high, the growth stocks versus the value stocks. And I'm in favor of them because I think in the long run, they are going to outperform. But boy, it has been tough. Value managers are sitting and suffering. And, some of them are just sort of maybe giving up the ghost and saying, hey, if I don't own some of these stocks, I'm just going to fall too much behind. As I say, right now in this environment where we see some softening in the real indicators, when you saw the Fed, say it was a little stubborn on how many rates it's going to cut, I actually think they're going to cut a little bit more after some of the stuff, some of the data that we've seen. You begin to wonder, should I be in small stocks? No. Should I be in cyclical stocks? No. Well, where's my refuge? My refuge is in Apple, Microsoft, and NVIDIA, and that's where the money's flowing.
Yeah, I was talking to somebody today about just the amount of retail in the market now definitely surpasses what we saw just 2 years ago. So that also moving the momentum needle. What are signs for you, Jeremy, though, of a blow-off top?
Well, you get almost a verticality of it, and when I look at these stocks, I don't quite see that. vertical. Where you see, these stocks go up 5–10% per day. Now, it's incredible to me to think of a $3 trillion stock doing that. Now, we saw, Apple in 2 days go up by 10%. That is also unprecedented. But what you usually see at that top is a big surge, everyone getting in the morning, ends down. It's called a one-day reversal. And usually that is one of the markers that shows for a top. There's usually another little rally that starts to try to make it. It doesn't quite make it. And then you see the interest fade in that group.
All right. And Professor, when we start to talk about this idea here of how the market sort of adjusts to the potential that we could actually see a pretty significant change in monetary policy later this year. We could see a significant change in economic conditions. And we're certainly, or I shouldn't say certainly, but we could see a change in our political picture as well come November. Is there any sort of incentive to be invested in this market heading into that?
Well, right now, if you look at S&P looking forward, we're at 21, 22. That's a little on the expensive side. But you take out tech, you're on 17, 18. That's not on the expensive side. Now, that argues for not going into that. But then you look at the day-to-day performance and you say, whoa, I'm not where the action are. And that's the tension, I think, that is really bombarding so many investors. From a long-term standpoint, it looks I should be cautious on tech, but from a momentum standpoint, and boy, momentum is an important factor, certainly in the short run and even intermediate run in the market. Boy, this is a momentum-driven market. So if you're a short-term trader, you got to be where that action is.